despite the sell-off in emerging market Eurobonds in late Q2, the market continues to see a rally in recent weeks despite the U.S. Fed's decision to delay on its bond tapering plan. For more on West Africa's sovereign debt markets, I'm now being joined by Samir Gadio, emerging market strategist at Standard Bank. Thank you so much, Samir, for joining us. Let's just quickly start with how much we've seen in terms of bond issuance by African countries. Now, I looked at one or two reports and I saw that it's now at a record 8 billion year to date. Now, some global managers are looking to increase their exposure to sub-Saharan African debt market, but they have come up with issues such as liquidity and scarce data, which they say may be a challenge for those of them who are looking to take up more African bonds. Is this a legitimate concern?
Well, I mean, I think actually we have a very good window right now to issue. As you know, the market was concerned about the fact that the Fed could start tapering QE in September. This didn't happen. And frankly, when you look at the global macro, the US macro figures, it's unlikely that the Fed will start tapering in December. And in fact, the chairman of the Fed, Bernanke, is leaving in early 2014. So that in itself kind of delays the process. So it could be that until at least Q1 2014, US Treasury rates remain relatively low, which will help African countries come to the market. So there are many countries in the pipeline, as you know, probably Nigeria, Ghana, Ivory Coast coming with a CFA International Eurobond. Senegal is also considering it. Then you have Kenya, probably in coming months, possibly Zambia, which yesterday announced that they were considering a 1 billion Eurobond next year, Angola, and so on. So there is really a wave of issuance in the pipeline.
Well, Samir, while more African countries are looking to issue more Eurobonds, we have quite a number of them on tap for that, including Nigeria. Do you think that there's a possibility of a high debt ratio going forward as more of them look to put more Eurobonds out there?
Well, I think for now, it's not really a major concern. If you take the case of Nigeria, external debt is still very marginal, actually. I mean, it's still around 3% or so, so they have room to borrow more in dollars. And when you think about it, if the exchange rate is stable, for most of those economies, actually, it's much cheaper to borrow in dollars than in local currency, assuming that they have the dollar cash flows to repay the debt. But having said that, I think you're pointing to a real issue, which is that in 5-10 years, we could get to a level where you have so much Eurobond issuance that some of those countries will actually eventually struggle to repay the debt. I mean, but we're not really there yet.
So what do you think looks more attractive for global fund managers now, the African debt, or do you think they'll be looking more to emerging markets?
I think African Eurobonds are actually attractive in the sense that they offer higher yields. I mean, if you look at the range of rates, it goes from about probably 3.8% in Gabon to almost 7.8% in Ghana, and in most emerging markets it's much lower than that typically. So, but the problem obviously is that you have a credit risk differentiation. I mean, some of the African Eurobond issuers are weaker when it comes to external fundamentals, fiscal policy, and so on. So you have to adjust your return on a risk basis.
Now, Samir, let me ask you this. For global fund managers who are looking at looking to take up African debt or perhaps stay with emerging markets, what do you think is most important for them right now?
Well, I think, you would look at the yield compression potential. So you have to actually identify a few names that still offer value. I mean, if you take for example, in our space, if you take the Ivory Coast 32s, there's a strong structural rebound in the country that Eurobond offers value. Sometimes you look actually at some kind of mispricing. I mean, if you take the Ghanaian Eurobond, it's trading, I think, at 7.8%, so 540 over US Treasuries. That's quite wide, even though you consider that the fiscal situation in Ghana has actually deteriorated. So that also offers value. Or actually, you could buy the Tanzanian notes, which are a floater. So in other words, you kind of hedge your US rate exposure, because if US rates go up, then that bond is going to pay you more. So it's very case specific in a sense. But I think you want to try to avoid the Eurobonds that have very expensive valuations. So if you take the case of Nigeria, the 10-year is trading at around 300 over US Treasuries. I mean, that's very, very risky in a sense, because frankly, if US rates go up, that bond is going to sell off. Or same with Gabon, 275 over US Treasuries. It is very expensive in our view, so that would probably be a short. Another country, in fact, where we're a little bit concerned is Zambia. The bond is currently trading at 6.7%, so that's about 420 over US Treasuries. But you know the country was recently downgraded by Fitch because of the deteriorating fiscal position. And they want to issue an extra 1 billion next year, potentially, which could reprice actually the levels of the current Eurobond. So I think you'd probably be a little bit cautious about this one.
Samir, African US dollar bond issuance is currently estimated or at a record $8 billion US year to date. How much bigger do you think this could get going into the new year?
Well, I think into the new year, probably not much bigger because there's very little time left. As you know, the next countries that will come to the market are probably Kenya, maybe Ivory Coast, and it looks like this is going to be a 2014 trade, to be honest, because it takes about 2 months between the time when they appoint a book runner and the actual issuance, and it's already almost November. But I mean, we're going to have probably a few billions of extra Eurobond issuance next year. That's for sure. And if you add South Africa to that and the North African countries, I mean, it's going to be a sizable number.